At 94 years old, I've made a decision that I never thought I'd make. This will be my last year as CEO of Berkshire Hathaway. On January 1st, 2026, Greg Abel will take over. And I'm going to tell you something. The decision to keep every single share of my Berkshire stock worth over $160 billion is an economic decision, because I believe the prospects of Berkshire will be better under Greg's management than mine. But before I, as the British would say, go quiet, there's something you need to understand. Something I need to explain about what I've been doing with your money. Because right now, at this very moment, Berkshire Hathaway is sitting on $334.2 billion in cash and Treasury bills. That's the most cash we've ever held in our 60-year history, more than we held before the dot-com crash, more than before the 2008 financial crisis, more than ever. And people keep asking me, Warren, why? Why are you holding so much cash? Why did you sell 2/3 of your Apple stake? Why did you dump billions in Bank of America? What do you see coming? So let me tell you. Let me walk you through exactly what I'm thinking, exactly what I'm doing, and exactly why you should be paying very close attention to what's happening right now. The numbers tell a story. Let me start with the facts. Cold, hard facts. In 2024, Berkshire sold $143 billion worth of stock. That's not a typo. $143 billion. We sold more stock in 1 year than most countries' entire GDP. And you know what we bought? Barely $3 billion. We've been net sellers for 10 consecutive quarters now. That's 2.5 years of selling more than we're buying. Apple was our biggest sale. We owned 905 million shares at the end of 2023, worth about $174 billion. It was half our entire portfolio. Today, we own about 300 million shares, worth roughly $70 billion. We sold 67% of our stake. That's $104 billion we liquidated from one stock. Bank of America was next. I invested $5 billion in Bank of America in 2011, right after the financial crisis. It was a vote of confidence in Brian Moynihan's leadership. We built that position up to over 1 billion shares. Now, we've sold more than 400 million shares, took 10.5 billion off the table, cut our stake by 39%. We sold HP. We trimmed Capital One. We exited Citigroup completely after holding it for just 3 years. We've been systematic, methodical, relentless. And all that selling, it generated $101 billion in taxable capital gains in 2024 alone. We paid more taxes to the U.S. government than any company has ever paid in a single year. Not because we had to, but because we chose to lock in those gains now. And here's what really gets people's attention. While we're selling everything, we're buying one thing: Treasury bills. Short-term government debt yielding about 5%. Our cash piles have gone from $167 billion at the end of 2020 to $334 billion today. That's a 100% increase in 1 year. Do you understand what that means? In 2024, our Treasury bills generated approximately $12 billion in interest income. $12 billion risk-free just from sitting in cash. That's more than most S&P 500 companies earn in an entire year. Now, people look at these numbers and they panic. They say, Warren's preparing for a crash. He knows something we don't. And I want to be very clear about this. I don't predict crashes. I've said it 1,000 times. I've never successfully predicted macroeconomic forecasts in 60 years at Berkshire. I don't have a crystal ball, but I don't need a crystal ball to understand value. And right now, I can't find value. The valuation problem, let me explain what I mean by value. It's actually very simple. When I buy a stock, I'm buying a piece of a business. And like any business purchase, I want to pay a fair price. I want to pay less than what it's worth. That gap between price and value, that's where profits come from. For most of my career, finding that gap hasn't been hard. The market panics. Stocks get cheap. I buy. Simple. In 2008, the entire financial system was collapsing. Goldman Sachs was trading at a fraction of book value. I invested $5 billion, got a 10% dividend, got warrants, made over $3 billion in profit. That's value. In 2011, Bank of America was struggling with mortgage losses. Stock was down 50%. I invested $5 billion at 7.40 per share. Today, even after all our selling, we've made over $14 billion on that position. That's value. But today, I can't find it. The S&P 500 is trading at about 24 times earnings. That's not cheap. The Shiller PE ratio, which measures valuations over 10-year earnings cycles, is sitting at 39. Do you know the only times it's been higher? Right before the 1929 crash and during the dot-com bubble in 2000. That's it. Apple, which I love. I genuinely think it's probably the best business in the world, is trading at 32 times earnings. When we bought most of our Apple stock between 2016 and 2018, it was trading at 10 to 12 times earnings. We paid 35 to 40 per share on a split adjusted basis. Today, it's over $120.30. The business is better, sure. But is it 3 times better? Has it tripled its intrinsic value? I don't think so. Bank of America was trading at about 1.3 times tangible book value when we started selling. Today, it's at 1.6 times. For a bank that's sensitive to interest rate changes, that faces regulatory pressures, that operates in a challenging environment, that's not cheap enough for me. And it's not just individual stocks. It's the entire market. Everything is expensive. Tech stocks are priced for perfection. Even value stocks aren't really value stocks anymore. And me, I'm supposed to deploy hundreds of billions of dollars in this environment. I can't do it. I won't do it. So what do I do instead? I hold cash. I buy Treasury bills at 5%. And I wait. The tax angle now, there's another reason I've been selling. And I talked about this at our annual meeting in May 2024, taxes. The current corporate tax rate is 21%. That's the lowest it's been since 1939, historically low. And I don't think it's going to stay this low. In fact, I'm nearly certain it won't. The U.S. federal deficit is massive. We're running trillion-dollar deficits year after year. Social Security is underfunded. Medicare is underfunded. At some point, taxes have to go up. It's just math. President Biden already proposed raising the corporate tax rate to 28%. That didn't pass, but it tells you where things are heading. So here's my logic. If I have massive unrealized gains in Apple, in Bank of America, in all these holdings, and I think tax rates are going up, what should I do? Lock in those gains now. Pay 21% today rather than 20% or 35% tomorrow. Let me give you a specific example. When we sold Apple at an average price of around 180, we had a cost basis of about 39 per share. That's a gain of 141 per share. At a 20% tax rate, we pay about 29.61 in taxes per share. We keep 111.39 per share after tax. We'd put weighted tax rates went to 28%. We'd pay 39.48 in taxes. We'd keep only 101.52 after tax. That's a difference of 9.87 per share. On 600 million shares sold, that's nearly $6 billion in additional taxes, $6 billion. So yes, part of this selling is tax strategy. Take the gains now, pay the lower rate. And if I'm wrong, if tax rates don't go up, well, I still made billions in profits and I have cash to redeploy. I can live with that. The lessons from history, I've been doing this a long time. And one thing I've learned is that markets move in cycles, always have, always will, boom and bust, expansion and contraction, euphoria and panic. And right now, we're in euphoria. Let me take you back to 1999 and 2000, the dot-com bubble. Everyone was convinced that internet stocks would go up forever. Traditional valuation metrics didn't matter anymore. It was a new economy. Companies with no earnings were trading at billions in market cap. Day traders were quitting their jobs to trade full time. And me, I was sitting there with cash. Everyone said I was washed up. I didn't understand technology. I was too old. I was missing the greatest investment opportunity of all time. Then the bubble burst. The NASDAQ fell 78% from peak to trough. Companies like Pets, Web, and eToys, they went to zero. Billions of dollars in market value evaporated. And I was fine, more than fine, because I had cash. I could buy great businesses at reasonable prices. Or take 2007, the housing market was booming. Banks were leveraged 30 to 1. Mortgage-backed securities were rated AA. Everyone was making money in real estate. Subprime is contained, they said. Housing never goes down. They said I was selling. We sold our entire position in Freddie Mac and Fannie Mae in 2001. We were very cautious with financials. We were building cash. And again, people thought I was crazy. Then 2008 happened. The entire financial system almost collapsed. Lehman Brothers went bankrupt. Bear Stearns was gone. AIG needed a government bailout. The S&P 500 fell 57%. And I had cash. I could act when everyone else was paralyzed. Now here we are in 2024 and 2025, and I'm doing the same thing again, building cash, selling positions, being cautious. And people are asking the same questions. Warren, are you predicting a crash? No, I'm not predicting anything, but I'm preparing because markets always revert to the mean. Valuations always come back down. And when they do, I want to have ammunition. What I'm now saying, let me be very clear about something, because I think there's a lot of misunderstanding out there. When I sell stock, I'm not saying the companies are bad. Apple is an incredible business. Bank of America is well managed. These are good companies. But there's a difference between a good company and a good investment. A good investment is a good company at a fair price. And right now, the prices aren't fair. I'm also not saying the market is going to crash tomorrow. I have no idea when the next recession will come. Could be next year. Could be 3 years from now. I don't know, and anyone who tells you they know is lying. What I am saying is this: when you can't find good investments, when valuations are stretched, when everyone else is euphoric, that's when you should be cautious. That's when you should build cash reserves. That's when you should be preparing for the inevitable downturn. Because the downturn always comes, always. In 60 years of investing, I've never seen it fail. Markets go up, markets go down. And the people who prepare for the down cycles, who have cash when everyone else is desperate, those are the people who get rich. The strategy going forward. So what am I doing with all this cash? Well, first, I'm earning 5% risk-free. That's not nothing. On a $34 billion. That's about $16 billion a year in interest income. That's more than most companies earn in operating profits. Second, I'm waiting, I'm watching, I'm looking for opportunities. And when stocks get cheap, when fear replaces greed, when panic replaces euphoria, I'll act, I'll deploy this cash. I'll buy great businesses at fair prices. But I'm not going to force it. I'm not going to invest just because I have cash burning a hole in my pocket. That's how you lose money. That's how you make mistakes. One of the most important lessons I've learned in 70 years of investing is this: it's okay to hold cash. Cash is a position. Cash is ammunition. And having cash when everyone else needs it, that's when you make your best investments. Let me give you a specific example. In March 2020, when COVID hit and the market crashed 34% in about 3 weeks, we had about $128 billion in cash. And what did I do? Well, I'll be honest, I didn't do much. I made a few small purchases, but mostly I held. People criticized me for that. Warren, you had all this cash and you didn't deploy it during the crash? And you know what? They were right to criticize. I should have acted more aggressively. But here's the thing: even when I make mistakes, I don't panic. I don't force bad decisions. I wait for the right opportunity. And look, Berkshire still did fine. Our operating businesses kept generating cash. Our stock holdings recovered. We're sitting at all-time highs. So even when I'm not perfect, and I'm far from perfect, the strategy still works. What this means for you now, I know what you're thinking. Warren, this is all well and good for you. You're running $1 trillion company. You've got billions in cash. What does this mean for me, a regular investor? And that's a fair question. So let me tell you exactly what I think you should do. First, look at your portfolio. Be honest with yourself. Are you fully invested because you believe these are great values? Or are you fully invested because the market keeps going up and you don't want to miss out? There's a big difference. If you're invested because of FOMO, fear of missing out, that's not investing. That's gambling. And gambling always ends badly. Second, build a cash cushion. I'm not saying sell everything and hide under your bed, but you should have some dry powder, maybe 10%, maybe 20% of your portfolio in cash or short-term treasuries. So when the inevitable downturn comes, you can act instead of panic. Third, look at valuations. Don't just buy stocks because they're going up. Buy them because they're trading below intrinsic value. And if you can't find stocks trading below intrinsic value, don't buy. Wait, I know that's hard. I know it feels like you're missing out when the market keeps hitting new highs. But trust me, the opportunities will come. They always do. Fourth, focus on quality. When valuations are high, you can't afford to own junk. You need businesses with strong balance sheets, with competitive advantages, with great management teams. Because when the market turns, junk gets destroyed. And fifth, think long term. Don't try to time the market. Don't try to predict when the crash will come. Just prepare, be ready. Have cash, have quality holdings, and when prices fall, and they will fall, be greedy when others are fearful. The Greg Abel transition. Now I want to talk about something personal. On January 1st, 2026, Greg Abel becomes CEO of Berkshire Hathaway. This isn't sudden. We've been planning this for years. Greg has been our vice chairman of non-insurance operations since 2018. Charlie Munger publicly identified him as my successor back in 2021. The board voted unanimously to confirm him. And I want you to know I feel great about this decision. Greg is 62 years old. He's a Canadian originally from Edmonton, Alberta. He's got a background in accounting. He's a CPA. He joined us back in 1999 when we bought a controlling stake in Mid-American Energy, where he was an executive. He became CEO of that business in 2008, and over the next decade, He grew it into what's now Berkshire Hathaway Energy with about $92 billion in assets. What I love about Greg is that he understands businesses, really understands them. He can speed read a balance sheet. He knows how to analyze operations. He's detail-oriented, but also sees the big picture. And most importantly, he shares our values: integrity, long-term thinking, decentralized management. Charlie Munger, before he passed away in 2023, said that Greg is sensational as a business leader, both as a thinker and as a doer. And Charlie was right. In some ways, Greg is a better business executive than I am. He works harder. He's more detail-focused. He's more hands-on with operations. Now, people ask me, Warren, can anyone really replace you? And the answer is no. There's no one who can replace me exactly. But that's not what we need. We don't need another Warren Buffett. We need someone who can run Berkshire Hathaway going forward. And Greg can do that. He'll have full authority over capital allocation. He'll make the investment decisions. He'll run the operations. And I'll still be around as chairman if he needs advice. But the final word will be his. And here's something important. I'm not selling a single share of my Berkshire stock during this transition. Not one share. You know why? Because I believe Berkshire will be better under Greg's management than mine. That's not false modesty. That's a genuine assessment. I'm 94 years old. I've had an incredible run. But it's time to pass the torch. And I'm passing it to someone I trust completely. The current market situation. Let me bring this back to the present moment. Where are we right now at the end of 2025? The S&P 500 hit new all-time highs in November. The market has been on an incredible run since the COVID bottom in March 2020. We're up over 150% from those lows. And a lot of that has been driven by a handful of mega cap tech stocks. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. These 7 stocks account for about 30% of the S&P 500's total market cap. That concentration worries me, because when the market is this dependent on a handful of stocks, any weakness in those stocks can have outsized impacts. And some of those stocks are trading at very rich valuations. Nvidia is trading at over 40 times earnings. Tesla is trading at over 60 times earnings. Even Microsoft and Amazon are trading at 30, 35 times earnings. These aren't value stocks. These are momentum stocks. And momentum doesn't last forever. Now, I'm not saying these are bad businesses. Nvidia makes great chips. Tesla makes great cars. Microsoft makes great software. But at these prices, I can't justify it. And it's not just tech. Even supposedly defensive stocks are expensive. Consumer staples are trading at 20, 25 times earnings. Utilities are expensive. Healthcare stocks are expensive. Everything is expensive. The only thing that's not expensive, cash. Treasury bills at 5% are actually attractive. That's why I'm holding so much of it. The Federal Reserve factor. I also need to talk about the Federal Reserve, because what the Fed does matters tremendously for valuations and for the economy. From March 2022 to July 2023, the Fed raised interest rates by 525 basis points. That's 5.25%. They took rates from essentially 0 to over 5%. That was the fastest rate hiking cycle in modern history. Why did they do that? Inflation. In 2021 and 2022, inflation was running at 8-9%, the highest in 40 years. So the Fed had to tighten monetary policy to bring inflation down. And it worked. Inflation has come down to around 3%. That's still above the Fed's 2% target, but it's much better than 8%. But here's the problem: high interest rates have consequences. They make borrowing expensive. They slow economic growth. They increase default rates. And eventually, they lead to recessions. Now, we haven't had a recession yet. The economy has been surprisingly resilient. But I don't think we're out of the woods. High rates take time to work through the system. And when they do, things can unravel quickly. Just look at what happened in March 2023 with the regional bank crisis. Silicon Valley Bank failed. Signature Bank failed. First Republic failed. Why? Because they were holding long-term bonds that lost value when rates went up. And when depositors got scared and withdrew their money, the banks didn't have enough liquidity. That was a warning shot, and I took note. The debt problem here is another thing that worries me: debt, both corporate debt and government debt. Total U.S. corporate debt is about $13 trillion. That's massive. And a lot of that debt was issued when rates were low. Companies borrowed at 2%, 3%, 4%. Now those bonds are maturing, and companies have to refinance at 7%, 8%, 9%. That's a huge jump in interest costs. For companies with strong cash flows, that's manageable. But for companies with weak cash flows, with high leverage, that's a problem. We're going to see more defaults. more bankruptcies, more restructurings, and government debt. Don't even get me started. The U.S. national debt is over 36 trillion. That's bigger than the entire U.S. economy. And we're running trillion-dollar deficits every year. Eventually, that debt has to be paid or serviced. And right now, the U.S. government is paying about 1 trillion a year just in interest on the debt. That's more than we spend on defense. That's more than we spend on education. That's not sustainable. Something's got to give. Either taxes go up or spending gets cut or inflation comes back. None of those options are good for asset prices. So when people ask me why I'm holding so much cash, this is part of it. I'm worried about debt levels. I'm worried about the sustainability of current valuations. And I want to be prepared for whatever comes next. The opportunities ahead, but let me tell you something, I'm not pessimistic. I'm realistic. There's a difference. I believe the U.S. economy will continue to grow over the long term. I believe American businesses will continue to innovate and create value. I believe in capitalism. I believe in the power of compound interest. What I don't believe is that stocks only go up. What I don't believe is that valuations don't matter. What I don't believe is that we can ignore fundamentals forever. So yes, I'm holding cash. Yes, I'm being cautious, but I'm not hiding under my bed. I'm preparing. And when opportunities present themselves, and they will, I'll be ready. Let me give you an example of what I'm looking for. I want businesses with strong competitive advantages. Businesses that can raise prices without losing customers. Businesses with low capital requirements. Businesses with excellent management teams. Businesses trading at reasonable valuations. Those businesses exist. They're just hard to find right now because the market is so expensive. But they're out there. And when the market corrects, when fear replaces greed, those businesses will get cheaper. And that's when I'll act. Think about it this way. I made some of my best investments during the 2008 financial crisis. Goldman Sachs, General Electric, Bank of America, Dow Chemical, Swiss Re, all purchased when everyone else was panicking. All phenomenally profitable. I made great investments during the dot-com crash. I bought companies with real earnings, real cash flows, real businesses, while everyone else was chasing internet stocks with no revenue. And I'll make great investments during the next crisis too, because I'm prepared. I have cash, I have patience, and I have discipline. Living below your means. Let me shift gears for a moment and talk about something more personal. Because I think one of the reasons I've been successful is not just what I do with my investments, but how I live my life. I've lived in the same house in Omaha since 1958. I paid $31,500 for it. It's worth maybe $1.5 million today. That's it. I don't own a yacht. I don't own multiple mansions. I don't collect expensive art or cars or watches. And it's not because I can't afford those things. I'm worth over 150 billion. I could buy anything I want, but I don't want them. They wouldn't make me happier. What makes me happy is financial security. The knowledge that no matter what happens in the economy, I'm going to be fine. My family is going to be fine. And that comes from living below my means, from saving more than I spend, from investing the difference. I see so many people, smart people, high earners living right up to their income, sometimes beyond it. They make $200,000 a year. They spend $200,000 a year. They make $500,000 a year. They spend $500,000 a year, and they have nothing saved. Then a recession hits. They lose their job, and suddenly they're in crisis. They have to sell their investments at the worst possible time. They have to take on debt. They're vulnerable. Don't be that person. Live like you make half of what you actually make. Save and invest the rest. Build your cash cushion. Build your financial security. Because when you have financial security, when you have cash, when you're not desperate, that's when you can take advantage of opportunities. That's when you can be greedy when others are fearful. The psychology of investing, I want to talk about something that I think is even more important than strategy or tactic psychology. Investing is not just about numbers. It's about emotions. It's about fear and greed. It's about patience and discipline. And the investors who succeed are the ones who can master their emotions. In 2008, I wrote an op-ed for the New York Times. The title was Buy American. I am. This was in October 2008, right in the middle of the financial crisis. Every day the news was terrible. Banks were failing, the market was crashing. Everyone was scared. And I was buying, not because I knew the bottom was in. I didn't. The market kept falling for several more months after I wrote that piece. But I was buying because I saw opportunity. I saw fear. And I know that's when you make money. But here's the thing: to do that, to invest when everyone else is panicking, you have to prepare yourself mentally. You have to train yourself to think differently than the crowd. When everyone else is euphoric, you need to be cautious. When everyone else is panicking, you need to be calm. When everyone else is buying, you need to consider selling. When everyone else is selling, you need to consider buying. That's hard. It goes against human nature. We're social creatures. We want to do what everyone else is doing. But in investing, following the crowd is how you lose money. So how do you train yourself? How do you build that mental discipline? Practice, visualization, study history, understand that market cycles are normal, understand that fear and greed drive short-term prices, but fundamentals drive long-term value. And most importantly, have a plan. Know what you're going to do before the crisis hits. Make your shopping list now. Identify the businesses you want to own at lower prices. So when the market crashes, you're not frozen with fear. You're executing your plan. My final advice as I step down from the CEO role, as I prepare to go quiet, I want to leave you with some final thoughts. First, don't try to time the market. You can't. I can't. No one can. What you can do is prepare for volatility, have cash, have quality holdings, and think long term. Second, focus on businesses, not stock prices. When you buy a stock, you're buying a piece of a business. Understand that business. Know what it's worth. And only buy when the price is right. Third, be patient. The best investments take time. Apple took us 8 years to build our full position. Coca-Cola we've held since 1988. See's Candies we've owned since 1972. Patience pays. Fourth, be disciplined. Don't chase hot stocks. Don't buy because everyone else is buying. Stick to your principles. Stick to your valuation discipline. And if that means holding cash for a while, so be it. Fifth, manage risk. Never use borrowed money to invest. Never put yourself in a position where you can get wiped out. Protect your downside, because if you protect your downside, the upside takes care of itself. Sixth, learn continuously. Read, study, think. The more you know about business, about economics, about human psychology, the better investor you'll be. I'm 94 years old and I still read 5 hours a day. Never stop learning. Seventh, be honest with yourself. Admit your mistakes. Learn from them. Move on. I've made plenty of mistakes in my career. I'm not perfect, but I don't dwell on them. I learn and I improve. And finally, enjoy the journey. Investing should be fun. Building wealth should be satisfying. Don't stress about daily fluctuations. Don't check your portfolio every hour. Focus on the long term. Live your life. Be happy. What happens next? So here we are, end of 2025. I'm stepping down as CEO. Greg Abel is taking over. Berkshire is sitting on $334 billion in cash. The market is at all-time highs. The valuations are stretched. Interest rates are high. Debt levels are worrying. What happens next? I don't know. Nobody does. But I can tell you what I'm doing. I'm holding cash. I'm earning 5% risk-free. I'm waiting for opportunities. And when the market corrects, and it will correct, I'll be ready. You should be ready too. Build your cash. Focus on quality. Think long-term. Be patient. Be disciplined. And remember, recessions aren't disasters. They're opportunities. They're clearance sales for great businesses. The people who prepare, who stay calm, who have cash, those are the people who get rich during downturns. I've been investing for 70 years. I've seen 14 recessions. I've seen bubbles and crashes. I've seen euphoria and panic. And through it all, one principle has remained constant: buy value, hold for the long term, and don't let emotions drive your decisions. That's how I built Berkshire Hathaway into a $1 trillion company. That's how I turned 10,000 into 150 billion. And that's how you can build wealth too. It's not complicated, but it requires discipline. It requires patience, and it requires courage. I've had a great run. 60 years as CEO, countless lessons learned, billions made. And now it's time to pass the torch. Greg Abel is ready. Berkshire is ready. And I hope you're ready too, because the next great investment opportunity is coming. I don't know when, but I know it's coming. And when it does, I'll be ready with 334 billion in cash. Will you be ready? Thank you, and good luck.